In this video, we're going to go over 6 different companies who are all being traded below their estimated fair value. The market has been hit as of late. We have seen a nice recovery over the past few trading days, but there are still 6 different companies that could be a nice addition to your portfolio that are all being traded below their estimated fair value from Morningstar. And for each of these companies, we're going to take a look at their current valuation, how the company may have some nice growth potential moving forward, and take a look at the current dividend payout for each of these companies. We have companies from various sectors of the market that are nicely diversified and will continue to generate revenue through any economic downturn. So in this video today, please hit that like button and subscribe. If you're new here, I am the Gen Z Investor, and every single day we talk about big stock market news and headlines, go over any big stock market event, and go over different companies you can buy and sell within your own personal portfolio. And in this video, we're going to focus on 6 different companies who are considered cheap right now and being traded below their estimated fair value. AT&T is the first company we're going to take a look at. Ticker T currently trades at over $28 a share and is down 26% this year. A market cap at over $205 billion, one of the largest communication companies in the world. If we take a look at their Morningstar report, the estimated fair value for this company sits at over $36 a share. So this represents AT&T currently being traded at around a 23% discount below the estimated fair value for the company. So this is one of the Dividend investors' top companies. They provide a massive 7% annual dividend to investors, and they only pay out around 65% of their earnings as a dividend. The one worry with AT&T is the balance sheet and the amount of debt they have, but they've done a nice job and they have a strong plan in place to reduce that debt over the next few years. So with this company, if you were to buy in today, you would get a 7.2% starting dividend yield, which is absolutely insane. They only grow their dividend at a rate of around 2% per year to match inflation each and every year. So you're not getting massive dividend increases, but your starting yield is already at a very high rate, and you could be getting this company potentially at a 23% discount from the estimated fair value. And if we take a look at their dividend safety score, they come in at a 65, represented as a safe dividend. So we aren't really worried about the dividend cut coming really anytime soon on the short term, but over the longer term span, if they can't improve their financial position, there may be a risk of one over the next few years down the road. But as of right now, no worry of a dividend cut, and they are doing a nice job of paying down their debt as soon as possible. Moving over, the second undervalued company right now is Merck & Co. Ticker MRK, coming in at $81 a share, and they are down around 3% on the 12-month chart. A company with a $200 billion market cap. And on the 52-week range, trading towards the center. And if we take a look at their Morningstar report, an estimated fair value for this company at over $88 a share, showing that they are being traded at around an 8 to 9% discount right now. And if we take a look at this company, the healthcare brand with a nice 3% dividend yield, they only pay out around 40% of their earnings as a dividend, and they have a 5-year dividend growth rate average of 5% per year. So you're getting into a solid company with a nice 3-year, 3% dividend yield that only pays out 40% of their earnings, so very sustainable and a lot of room to grow the dividend moving forward with a nice average growth rate of 5% per year. If we take a look, they have the highest dividend safety score possible. Considered very safe, we don't have to worry about a dividend cut coming anytime soon in the near or longer term future. A very solid company. To get them at around an 8 to 9% discount right now may be a nice addition to your portfolio if you're seeking some dividend income. And they grew their dividend 11% last year, which is considered fast, and with a low beta, you're not buying into a very volatile company. The third stock on our list today is JP Morgan Chase, down 10% this year. So of course the banks have been hammered as of late. JP Morgan before the pandemic was trading at over $135 per share, and then for the past few months have been trading around that $100 mark with a slight run up as of late. Still on the middle of the 52-week range, slightly towards the low side, and they have a market cap of $355 billion. If we take a look at their Morningstar report, the fair value for this company sits at $137 a share. So they are considered being traded at an 18% discount right now relative to their estimated fair value. So another company that is very strong, the leader in the financial sector within the United States, one of the largest banks in the entire world by assets, and they do a great job of being an innovator, being a market leader. They are now going after Square and PayPal, competing in the small business, collecting payment space. They're invested in Bitcoin now as well with their own personal cryptocurrency. They're doing a lot of good things with this company. I still own JP Morgan. It is my largest financial stock in my personal portfolio, and getting it at around an 18% discount might be a nice addition to your portfolio as well. And if we take a look, still paying out a 3% dividend if you were to buy in today. They only have a payout ratio of around 48% of their earnings and a massive 5-year dividend growth rate average of over 16% per year. So of course, as of right now, they are not allowed to increase their dividend payment because of the Fed making sure we can get the economy back up and running before they do just that. But they still have the potential, once they are allowed to, I believe they will increase that payment and continue to do so over a longer term span. And they have a dividend payout ratio, if we take a look, at 60. So right at the borderline safe. That is because of the economy. That is because of what's really been happening as of late because of the pandemic. With interest rates at all-time lows, people were scared of banks. But now we saw a slight increase in interest rates. There's kind of some potential and some hope that the economy will recover over the next 12 to 18 months. And I do believe the dividend is safe. They will maintain their current payment. And once they're allowed to, I see them continuing to increase into a new dividend growth streak moving forward. Moving on, the fourth stock on this list is the only company that does not pay out a dividend, and that is Berkshire Hathaway. This is Warren Buffett's company, and it's one of the largest in the world with a market cap of $535 billion. This company has been around for a long period of time, and essentially, this is almost like an ETF. Warren Buffett invests and owns assets in various different companies across the world, in various different sectors of the market, and when you were buying into Berkshire Hathaway, you were essentially buying a small piece of all the companies he owns. So this company does not pay out a dividend, it never has, and Buffett says it never will. He rewards shareholders with share buybacks, and this is a company that set a record high. Buffett bought back over $9 billion worth of Berkshire shares over his latest report. And if we take a look, the estimated fair value for the company is at $245 a share, which represents shares could be trading at around an 8% discount right now. So if Buffett spent a record high $9 billion on share buybacks, I believe he knows his company is undervalued at this current level. Buffett likes to say that he only buys back shares when he thinks Berkshire is at a better price point compared to other companies on the market. And when he spent a record high on share buybacks, I think he sees the same things we're seeing here, that his company is considered undervalued. And Buffett still has one of the best balance sheets on the market with over $147 billion in cash, which will allow him to literally buy almost any company on the market. He can acquire a large chunk in some of the biggest brands in the world, or he can actually acquire some smaller companies outright for his portfolio. So he's been sitting on the sidelines for a long period of time. A few months ago, we saw him add to his Bank of America position, and he sold out of some of the other banks. And it's very kind of inconsistent on what he's been doing, but he's sitting on a ton of cash. We don't know what he's waiting for right now, but it'll be very interesting to see what he sees in this market moving forward and what assets he chooses to buy with this large cash position. Stock number 5 of some cheap stocks you may want to pick up today is Cisco. Ticker CSCO, currently trading at around $38 a share. They are down 20% this year, a company with a market cap of $163 billion, trading towards the low end on the 52-week range. They have a nice dividend yield right now at 3.7%, and the fair value for this company sits at over $41 a share. So around a 7% discount on Cisco right now, trading about 7 to 8% below their estimated fair value. Another company that pays out a nice 3.7% dividend. They only pay out around 46 to 47% of their earnings as a dividend, leaving them a lot of room to reinvest back into the business and grow the dividend payment moving forward. As well, they have a 5-year dividend growth rate average of over 13%. Very high dividend growth rate. We love to see it, and I believe that will continue to grow very nicely. And if we take a look, a nice dividend safety score coming in at 91. So considered very safe. We don't have to worry about a dividend cut coming soon, and that is what we're kind of looking for in this type of value play with a nice dividend yield. And moving on, the last stock on our list today, company number 6, pays a massive dividend of 7.93%. Usually once dividends reach that 5% plus mark, they are considered riskier, you should kind of stay away from that. But Pembina Pipeline Corporation, PBA, may be one that can actually sustain it over the long term. Down 33% this year. Of course, they were hit extremely hard when the price of oil crashed. And this is a pipeline company with some strong infrastructure that could be sustainable over a long term and may be able to continue to pay out this monthly dividend that currently sits at 7.93%. If we take a look, the estimated fair value for Pembina sits at $29 a share compared to the current price at just over $23. So you have around a 24% discount on the current share price for PBA. So this company owns a lot of pipeline infrastructure. And with pipelines, they are not really tied to the actual price of oil. They have long-term contracts that are signed way before we saw the decline in oil that will allow them to have consistent cash flows moving forward, and that is how they are estimated to continue to pay out their dividend without any worry, because a lot of their revenue is tied to some long-term contracts that have already been signed and the companies have to pay whether or not they ship the oil. And with the new presidency, where Biden is very unlikely to approve any new pipeline contracts, existing infrastructure are going to go up in value because no new competition will enter the market, and the pipelines that are already existing in the world today and already owned by billion-dollar companies are going to be the only way to transport oil across North America. So if we take a look, they currently yield 7.93%. They do have a high payout ratio because of the earnings. This isn't the best way to kind of value a pipeline company because they have a lot of depreciation expense, which is a non-cash expense. It reduces their earnings per share numbers. If you take a look at this company and do a deeper dive into the cash flow from operations and the free cash flow, the dividend does seem sustainable right now. And if you take a look, they have a dividend safety score of 80, which is considered safe. So Simply Safe Dividend has one of the strongest indicators to predict any dividend cuts, and they actually reaffirmed earlier this year this dividend safety score of 80, which represents a safe dividend, so we're not really worried of a dividend cut from PBA anytime soon. So those were 6 different companies who all reported their latest earnings. As of late, all these companies are considered undervalued or cheap at the current price point. And if you like any of these companies, let me know down in the comments below. Hit that like button, subscribe, and see you in tomorrow's video.